Ground floor, talking with experts, and I'm here with Mark Willsmann, who just finished on a debt market conundrum panel, giving us some of his expertise. And Mark, you're talking about life companies having one of the biggest record years this year in terms of lending. So what are some of the market prevailing conditions that have really had you guys on top?
Well, I think the biggest reason is just the ongoing dysfunction in the CMBS market. And CMBS, traditionally has had double the share of the slice of pie of the market than life companies, and they've been largely out of the market here the second half of the year, and in the first half of the year again we're kind of struggling. So that's opened a pretty broad landscape for us to do more lending than we had in the past, especially on the higher quality stuff that they had done.
Well, that's good. Let's talk about those opportunities, because I've heard life companies typically look for good sponsorship, long-term opportunities, but there are some creative things on this panel that you were talking about, even regional malls. So what kind of things are attractive to you guys today?
Well, the regional mall space traditionally had been dominated by CMBS, not because it was risky, but because they were able to offer a very, very low cost of capital. They can't offer that today, so life companies really offer the most attractive source of financing for people like Simon and people like GGP and people like Taubman and Westfield, et cetera. So we've done probably 6 or 7 major regional mall deals, kind of ranging from $200 million to $450 million each.
Let's continue to talk about the opportunities in the market then. As the competition begins to increase, do you think you'll have more competition in 2012 or more allocations of money to give?
We expect to actually do more lending. Our plan is to do about 30% more next year relative to this year. And again, we think that the landscape will be friendly to life companies in that, again, CMBS is going to be a relatively expensive cost of capital source. You have the agencies that are in government conservatorship, so they aren't as aggressive in lending on apartments as they had in the past. And then you still have a number of major banks that are still dealing with real estate problems and aren't as active lending as they had in the past. So that opens the door for life companies to do more.
Okay, so a pretty optimistic outlook for you. Very nice to hear that, Mark. We'll keep our eyes on the life companies this year and into 2012.
Very good. Thanks.